The next company in our portfolio is Apple. Yes, Apple is a dividend growth company, which means it not only pays dividends, but it also has tremendous growth potential. Now, we all know what Apple does. It makes iPhone, the Mac, the iPad, the watch, AirPods. Apple's ecosystem is so vast that you can see many people using their products in day-to-day life. Now, dividend yields of such high growth companies are actually relatively less. If you see here, the yield is just modest 0.52%. The P is also a little tad higher at 27.5. You see the 1 year performance of this company, it is 29. Whereas for the last 5 years, it has grown at almost 400%. Look at the dividends, it is like paying for the last 9 years with a good 5 year growth rate of 9% and a very good payout ratio of below 15. Now, Apple is the largest company in the world by revenue at almost 2.8 trillion US dollars. So that payout ratio is justified. Next in our portfolio, we have a similar company like Apple, that is Microsoft, which, like Apple, produces computer software and personal computers and stuff like that. We look at the brands that Microsoft owns. It has the popular Microsoft Office. It also has the Windows operating system and multiple other apps like Microsoft Teams, Skype, and devices like Microsoft Surface. One area where Microsoft has been growing tremendously is its cloud business with its Azure brand. Microsoft is again well diversified across the board. Like Apple, Microsoft is also a dividend growth company where it does provide a small dividend. We see here it just provides a yield of below 1%, but it has shown a tremendous growth in the past. We see a 1 year of 19% and a 5 years of 350%. These dividend growth companies do give you that tremendous growth opportunity and also pay a dividend on the side. We look at the dividends for Microsoft. We see it has been paying for last 18 years at a good growth rate of below 10% and a payout ratio of 26.6. Microsoft is the second largest organization in the world by revenue with about 2.2 trillion USD in market cap. Next in our portfolio, we go to the utilities sector, wherein we see AWR, which is the American States Water Company, which provides water and electric utilities. American States Water Company has a dividend yield of 1.72%. When we go to the dividends, it has been paying for the last 19 years with a good growth rate of below 9%. The payout ratio is little higher, I would say, around 54%. The thing about water is, more we see situations like global warming and stuff, water is becoming more and more precious going forward. These utilities will play a major role in our future. Next in our list is another utility company, which is Duke Energy, which is an American electric power and natural gas providing company. Duke Energy has a yield of almost 4% with a P just over 18. And from a dividend standpoint, it has been paying for the last 7 years. The 5 year growth rate is pretty modest at just below 3%, and the payout ratio is just about 75. The thing about utility companies is they don't provide amazing returns like an Apple or Microsoft. So they are like slow and steady companies which keep providing dividends, keep growing slowly. And basically, we can say them as boring companies. What we saw till now were 20 companies which are across the board. And the last one that we have in our portfolio is an ETF, which is SCHD. That is the Schwab US Dividend Equity ETF. This is a well-rounded, well-constructed ETF that considers many factors in choosing the stocks it has. It has a dividend yield of 2.9%. And when we go deeper, it has been paying for the last 9 years at a good growth rate of over 12%. The best part of this ETF is it stands its ground when we even compare it with an index fund like WU, which tracks the S&P 500 index. If you look here, over the last 1 year, this dividend ETF has actually outperformed the S&P 500 index by almost 3 points. When you look at last 5 years, it has gone neck and neck with it. So you get a good performance and also you're getting dividends on the side, which makes it an amazing combination. So if you look at the entire portfolio, the way it has been constructed is that these companies are something which we use them regularly. And that is what I mentioned earlier in the article. We should know what we are investing in. If you are using your Verizon mobile service, or you're watching your television on the Comcast service, or you are buying something at your nearest Target or Walmart, or using a Procter& and Gamble product, or using your Apple product or a Microsoft service, you know that those are the companies which you have invested in. So that is the premise of this entire portfolio. The way this portfolio has been structured is 80% of the portfolio is spread across 20 stocks and 20% of it is in an ETF. So this entire portfolio yields about 2.55%, which is almost double that of the S&P 500 index. And when we look further, here we see with our assumption of we're investing $1,000 into this portfolio, we see it generating around $25.60 for the entire year. And here we see the portfolio composition. Because we have 80% of our portfolio spread across 20 stocks, we see each of it holding around 4%. And this is our the entire pie showing the distribution of dividends across the sectors. And I'll provide a link to this sheet in the description notes for this video, wherein you can access it, you can and play around with the data. That's the portfolio consisting of 21 holdings, which I feel should be a good starting for any investor. It has a mix of high growth companies like Apple and Microsoft, and also the boring utility companies. So I feel this portfolio is a very good one to start off. We can backtest our portfolio using this amazing website called Portfolio Visualizer, wherein what we do is we feed in all the information that we have for the portfolio. So here you can see I've given all the 20 stock holdings, each with a 4% allocation, and the SCHD ETF with 20% allocation. And what I'm doing this, comparing this entire portfolio against the S&P 500 index ETF VOO, which has 100% allocation. So I'm comparing portfolio 1, which is our starter portfolio, and the portfolio 2 is the S&P 500. And what I'm doing here is giving the start year as 2012, so that's dating back to 10 years ago. My initial amount is just $1,000. I'm not adding anything after that. And only thing I'm doing is I'm giving this option as yes for the reinvesting the dividends. Let's say yes to display the income also. And let's say analyze. Okay, so here we have the results. What do we see here? Our startup portfolio has the final balance of $5,419 compared to $4,370 for the S&P 500 index. And you can see here the CAGR, which is the compounded annual growth rate. So that's the annual rate at which our portfolio is growing. So the starter portfolio has 18.25% compared to 15.75 for the S&P 500. Now these are amazing results. And we scroll down, we can see how the portfolio has performed over time. And when we scroll down, what we can see here is the portfolio income. As our portfolio's dividend yield is almost double that of the S&P 500 index. We see that in this chart also. So every year we see the income generated by our portfolio being considerably higher than that of the S&P 500 index. Let's do one more change. We go here and say we started off our portfolio with $1,000 investment, and every month, let's say we contribute a fixed amount of just $100. Let's not we'll put it, contribution frequency is monthly, no rebalancing, everything else remains the same. And let's say we analyze portfolio. So again, what we see here, our startup portfolio has $36,852 compared with $31,556. So that's like more than $5,000 generated by our portfolio compared against the S&P 500 index. But even the CAGR values are almost 3% apart. These are really amazing results. What this goes on to prove is that if you apply proper selection criteria while selecting the stocks for your portfolio, it can give amazing performance results. If you have found some value from this video, Would really appreciate if you can leave a comment saying what you liked about the video and what you would like to see in the future. Thanks for watching. Please like and subscribe to my channel. Keep informed about all such informative videos in the future. I'm not a financial advisor, and all the content you would see in this channel is for educational and entertainment purposes only. Everyone should do their own due diligence before investing their hard earned money.